Hello and welcome back to another video. Today we're going to be talking about the Mag 7. The Mag 7 consists of 7 stocks that are actually the top of the US large cap. The S&P 500, they're just the heaviest weighted stocks and they have the most market share. That's going to be Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla. With that being said, they are in the highest market share and they have the highest weight in ETFs. They made up roughly 40% of the S&P 500's return in 2025, which is fantastic for anybody who has invested in them. Are they still a good investment? That's kind of where I'm going with this video. And I want to talk about why there is the divergence that we're seeing. These companies are reporting great, strong earnings. Why are their share prices going down? That's the divergence that I would like to talk about. Number one is going to be their crazy CapEx anticipation, what they're expecting to spend compared to what they were estimated to spend. The reason why some of their earnings reports are so good is these data centers are highly profitable. They were high cost to build, but they're low cost to maintain and high profit margins. The chip depreciation is something else I want to talk about. Chips physically function for 5 to 6 years, which is exactly what NVIDIA said. And all these companies that bought the chips, they're saying that, oh, no, they depreciate over 5 to 6 years. We're good. And everybody's saying that they depreciate within 1 to 3 years, I believe is actually what NVIDIA said. Now, the reason why that is they still function for 5 to 6, but they're outdated within 1 to 3. There's a new iPhone every year. It outdates the one previously. They stopped selling the one, 3 years prior, something along those lines. It just can't compete with new technology, right? The new chips are going to be that much better, that much more output, that much more utilization, which is going to cause them to actually have a 1 to 3 year depreciation depending on what these chips are used for. Which it brings me into my next point is, are these companies going to offload the old versions and buy the new as they come out? Or are they going to kind of use them until they're dust and then move on from them? That is going to be yet to be seen, and I hope that it doesn't end up flooding the market. However, the new chips are going to be so significantly better that I actually believe that they're going to be constantly buying the new chips. Now we're going to take a look at Apple. I want to bring up that these are the best dynamics and different things to look at when investing into a company for me. Does not mean that my research has to be what you research, anything along those lines. I'm not a financial advisor. However, these different dynamics is what I use to be able to see if it's a company that's worthwhile to me to invest my own money in. So let's get into it with Apple. Income, 42.1 billion. Fantastic income. Their EPS was up 19% year over year at $2.84, which they beat estimates. Their PE, price to earnings, is 32.3 with a 10-year average of 24.05, which is just fantastic. Their price is higher than their 10-year average, which hopefully means that they're still growing and they're still in the growth cycle, which is exactly what they reported on their earnings when they reported revenue growth was $143.8 billion, which was up 16% year over year, which is just fantastic. If you can get a company that beats on EPS, revenue growth, everything along those lines, they're also as big as Apple, which makes it very hard to beat on these percentage bases. It's just fantastic to see. Now their moat. They have a very wide moat, and some even say impenetrable. They own an entire ecosystem. Once you're into the Mac, you don't switch back, right? That's kind of where everybody's with it. And their iPhones, you have Apple, you have Android. That's their competition, right? The reason why most people end up sticking with the brand name, they have loyalty to that name, and it's just ease of use. Do you really want to have to reteach yourself how to use your smartphone? No, you just buy another Apple, and then you have to deal with a couple of annoying changes. That's about it, right? They own that ecosystem, and people are not penetrating in significant. They have competition on smartphones. Okay, Android. You got Amazon EcoBuds and over their AirPods. They do have competition, but their competition doesn't own an entire ecosystem like they do, and it's all compatible with one another. All right, moving on from their remote cash flow. They had $53.9 billion and they have $66.91 billion in reserves. Be great to get our hands on some of that, right? Their debt was $90.5 billion, but that's actually down from a peak of 136 billion in 2021. So they're spending, but they are also lowering their debt, which is fantastic to see. Their CapEx is predicted to be 14.3 because they still have yet to report earnings, but anticipated to surge just like everybody else's. That's where a lot of fear in the market is actually this CapEx spending and then not being able to see where the ROI is. So we'll see if they keep their CapEx down and at a manageable rate. They have a huge partnership with Google to use their Gemini AI to power Apple Intelligence. That's fantastic. I think it's actually going to be a good thing. They're kind of cornering the market on it, but if you can't be a leader, why not lean on the one that is, right? That's at least the logic I'm putting behind it. Not saying that Gemini AI is the leader in the space, but Google is a fantastic company as well. Also a Mag 7, right? They spent 32 billion in share repurchases. To me, that shows strength. Some people say that share buybacks actually can show weakness. They're trying to drive up their price. However, I think that they're buying it back because they see what is happening in the future. Their Q2 2026 guidance company projects 13 to 16% revenue growth. That's fantastic to see. If they beat on that, that keeps them in that high teens, low 20s% revenue growth. That's going to be fantastic. And I definitely would not mind being a part of that, right? Gross margin projected to be between 48 and 49%. That's also fantastic. And they continue to pay down debt, which is exactly what I like to see. High cash flow, high cash on hand, low debt. We're going to take a look at the chart here and see where I am going to be actively buying in on Apple. I do actually consider Apple a buy. I think they're a fantastic company, and I think they're going to continue leading the market. They just bounced off of a resistance up here. You can see they kind of played around it. They tried shooting up above and kept dropping below, and then they crashed hard. They moved down below their 50-day moving average, which is it's good for us who are hunting value at a good price, right? With that being said, they bounced down. I'm actually anticipating they're currently at 255.78. I'm looking at buying anywhere from between where they are now, especially at their 150 day, which is 215, which is all the way down here, and the 246. So if I can start picking them up between 255 and 246, below 246, though, I am actually looking at increasing how much I am purchasing of Apple. That is going to be in between 246 and 215. Anywhere in between there, I'm just going to keep buying like I can't get enough. However, right now I'm just in a mode where I'm going to be DCAing in a strict percentage. 10% of what I put in is going to go into Apple, something along those lines. So it's going to be, a share or two here and there, maybe even upwards of 5, depending on how the market does that day. And with that being said, I think Apple's a buy. I don't think it's a strong buy. It's a buy hold in that range. But if it continues dipping, that's going to increase the amount of spending I'm actually going to put into Apple. So just something to think about. And just because I'm doing it does not mean you need to. So Microsoft, we're going to move into the second of the Mag 7. Their income was up 21% year over year, 38.3 billion. Gotta love those numbers. EPS is 4.14, which is above the estimate of 393. PE is 25.1, which is under their 5-year average of 32.38, which is actually fantastic to see, meaning it may be more of a value play. Their revenue growth was up 17% year over year at 81.27 billion. They have a very wide, robust moat. They have Windows dominance, they have Azure, and Microsoft 365. It's just fantastic to see. However, they did raise the Microsoft 365 prices, which was not as fantastic. But if they make me money by owning their shares, then I'm going to be all right in the long run. Excuse me. Their cash flow was 77.4 billion with 89.5 billion in reserves. Fantastic to see that they actually have that much in reserves when their debt is 100.41 bill. They could pay the debt down if they wanted to. And the next part is what's a little scary. CapEx, they spent 37.5 billion, but they're anticipating to spend 100 billion plus in this coming up year. That was kind of scary, and a lot of people did not like that. They had very strong earnings reports. It's just the CapEx spending, which is kind of crazy. Their revenue projection is 81.75 billion or 15% growth. I believe that they're going to beat on that. However, depending on where this CapEx spending is, their rate of return may be a little suggestive as to when they're going to start seeing those returns. AI adoption and cloud expansion is driving the stock price. It's fantastic. Their AI adoption is huge and their cloud expansion is on point. They are making some money from the cloud. Azure revenue increased by 40%. That's great to see that they're actually improving their revenue from other dynamics of their own business. That just shows that they are a strong company. Even their lower revenue portions are increasing at a 40% clip, which is just fantastic to see. I'm excited to see what happens next earnings report to see how much revenue Azure actually made them. They also have a $625 billion backlog. Tell me that's not a strong company. Having over $500 billion in a backlog, that's fantastic to see. All right, this is what I was talking about right here. You can see right in here is where they reported earnings. They reported, everybody had good intentions coming up to it, and then CapEx, bam. So Microsoft is just kind of cruising on down. They hit resistance down here at 389. I bought in around that 408 mark. I bought a few shares there. I'm going to continue hunting and buying and DCAing in. Now, if they break below this 389, then they have 378.16 as support. So if they get down into that channel, I'm going to be buying quite a bit more shares, depending on the reasoning behind the dip. I'm kind of hoping for that. I love buying these stocks on value for cheap. Good value stock for very cheap. I anticipate that by the end of the year, mid-year, they're going to be back up into that 459 range, somewhere in here. They're where they were roughly when they reported earnings, once they can get a hold on where they're actually spending that CapEx spending and where their mindset is on where that money is going to go and where they're going to start seeing some return on that investment. We're going to move into Google, which was the one that I was just talking about, partnered with Apple, right? They had income, which was 132.2 billion, and their operating was 129 billion, which is up 15% year over year. Their EPS was 10.81. They still have to report earnings, so I will get a updated EPS once that happens. PE was 28.28. Funny that, huh? With a 5-year average at 24.77. So they're above their 5-year, which shows some strength in the company. However, their CapEx is supposed to be a lot more. So it's going to kind of hurt the short term. Once people start getting less fearful, then maybe we can see a good turnaround on some of these stocks. They have a very strong moat, and they are untouchable in their moat, once again, just like Apple. However, they do have fear of a threat from AI. Grok, all those different AIs that are kind of popping up out of the woodwork. They anticipate that Gemini's AI and Google is going to suffer from that. However, it has no indication that it has. And if I'm not mistaken, Google searches are actually up as well. It'll be interesting to see, but I don't think it's going to knock them out and be direct as much competition as what people anticipate. Their cash flow was negative 73.3 billion, and operating was negative 164.7 billion with 126.8 billion on hand. That is kind of crazy, but they've been reinvesting that money, which they spent $91.4 billion in capex spending last year, and they're anticipating to spend 185 billion in 2026. So they have spent a lot of money. Their debt is 59.3 billion long term, and they just added 32 billion new in February. Those numbers start to get scary when they're spending that kind of money, right? Money that they don't necessarily have. I'll be interested to see, and I think that they're going to be a very strong company going into the future. That kind of makes me a little skeptical on if right now is a really good time to buy, or are they going to keep this insane spending and be able to actually hit them up at a cheaper price. The Google Cloud revenue was up 48% at 17.7 billion. Fantastic. Waymo is not positive yet, but moving in the direction with growing rides, and they have a valuation of 126 billion. Once again, parts of the reason why they had negative cash flow this last reporting season. If Waymo ever does get up and running, you do have competition with them, but they are by far the leader, in my opinion. And I think as soon as they start reporting positive numbers on that, things are just going to get a little crazy. And then they have quantum computing integration. They have the Willow chip, which is 13,000 times faster than supercomputers. A typical supercomputer, not the fastest in the world, but a typical one, right? With that being said, quantum computing has always been a factor in my mind of something I've always enjoyed investing in. I do actually believe it's going to be the way of the future. It's going to decrease the amount of energy needed to be able to compute all these different tasks, however you want to say that. But they are going to be a part of the future. And it's going to be fantastic to see that. And I think Google is going to be a main contributing factor to it, especially with this Willow chip getting integrated. It's going to be fantastic to see what comes out of that, which is a reason why I'm interested in Google, even though they're crazy CapEx spending. But the CapEx spending is for the AI infrastructure, also the Google Cloud infrastructure, Waymo, things along those lines, trying to drive all these sectors of their company in the right direction. Let's take a look at the chart here and see where I would be interested in buying Google if I am. You can see they've been on a downward trend. So right here at that 294 mark right in here is where I'm going to be interested in spending. Anything under 300, I'm going to be a buy on Google. I'm going to start buying shares. The thing that's scary is the fact that they're spending so much money. But if they start seeing some returns on that money, it's not going to be a over these next 3 months the stock's going to slowly go up. It's going to be a rapid growth cycle, potentially, as long as we can actually see where that return is coming from and how much that return is coming from. So if they project their earnings and they just have a huge spike in growth, it is not going to be we go up $2 today, $2 tomorrow. It is going to be a gone with the wind or seeing new 52-week lows. There's not really going to be much in between. With that being said, I think that I'm going to continue buying Google. I'm going to be DCAing in once again at a very small clip, 5-8% of what I DCA in will start going into Google just to continue loading up on one of the best companies, in my opinion. I just like them. I think they're going to do well. I see them being in the $400 to $500 range. within a year or two. I think it's going to be fantastic, especially if they keep putting up those kind of earnings. Moving into Amazon. Amazon, their income was 21.2 billion net and 25 billion operating. They missed on their earnings per share, but it did increase by 4.2% to the same quarter of the previous year. It's good to see that they're still increasing. Did not have the kind of growth that I would actually be looking for when it comes to all that. Their PE is 27.7, which is significantly lower than their 10-year average at 42.09. Their revenue did grow 14% year over year at 213.4 billion. Their moat is wide. They have huge competitive advantage and loyalty over these other companies. Most of these companies that are currently driving some of the markets, their most competition is actually coming from Amazon. So they are like the gatekeeper when it comes to competition. It's fun to watch and fun to see. Their free cash flow was 38 billion due to investments, and they have 101.2 billion on hand. Their debt is 169.9 billion to 178.5 billion, and their capex was 131 billion in 2025 and estimated 200 billion in 2026. With all that being said, let's take a look at the future guidance and see where they're going from here. Their revenue for quarter one is estimated to be between 173.5 and 178.5 billion, which is fantastic. I hope they do that. Operating income guidance below expectations at 16.5 to 21.5 billion. Their AWS is expected to grow by 30%, revenue expected 11 to 15%, and their operating margin squeeze due to infrastructure depreciation. We're going to take a look at the chart, and I'm going to talk about Amazon real quick and see where I'm at with it. You can see they came down from 238.69 and they broke through resistances after resistances, and they came down here a little bit higher than what they actually closed at 198.79. Now, when you have a company drop $40 in a matter of a week and a half, that's not great news. But that capex that they reported is just kind of insane. They have pretty high debt. They missed on their earnings per share. They don't have the highest revenue growth, but they are still an amazing company. With that being said, I'm not going to sell any of my Amazon shares. I'm not also going to buy unless I see something else happen. Now, if they come down here below this 190-ish mark and start trading below 190, I might be inclined to pick up a few shares. I might even be inclined to pick up a risky call, something along those lines. But I do not like the numbers that I saw, and mostly just the insane debt and capex. To increase your capex spending by $69 billion, they do have a huge competitive advantage, but they're trading below their 10-year average pretty significantly, and it's because they didn't grow like they used to. They're a huge company, though, so nobody really expects them to grow like they used to. But it would be nice to be able to see where some of this money is going before I further invest into Amazon. So right now it's a hold. Maybe in the near future it might turn back to a buy, but I'm going to keep on. Meta. Their income increased 9% to 22.77 billion. Their EPS was 88.88, beating by 72 cents per share, which is fantastic to see. Their PE is above their 5-year average at 26.7. Their revenue growth in Q4 was $59.89, and that is a 24% year over year increase. They have a very wide moat, and they're building a compute moat, which is heavy in their AI investment. That's going to be fantastic. I made a little spelling error there. I'll get that fixed up. And their moat is going to be huge. Nobody's going to be able to really compete with Meta at any time soon in what they're doing. You just don't come out with a new Facebook overnight. It's just not feasible or possible. Cash flow in 2025 was 43.59 billion with 81.59 cash on hand. They do have a debt of 90 billion, but I actually like those numbers. They could easily take their cash on hand and their future cash flow and put it right back in and pay off most all of that debt, which is fantastic to see. Their capex in 2025 was $72 billion, and they are anticipating 135 billion in 2026, which is over double what they spent. The scariest part about all that is when you take a look at their cash flow. You're taking their old capex with their current cash flow, and you're pretty much spending most of what they're making. You're talking about only having like a coverage of like $20 billion. So if they go over on what's anticipated, they really don't have the cash coming in to be able to pay for it. However, I should say they have the cash coming in to pay for it within a certain amount of range. So if they go over that $20 billion, then yeah, they don't have enough cash to cover it. But if they take on a little bit more debt, they're still moving forward. It's not that they're just dead in the water. It's just not a good look. So their PE is a little higher. Their growth is fantastic. Their revenue growth is fantastic to see. I do like Meta. I think they're going to be big in what's coming with this AI. They want to be the personal super intelligence through heavy capex spending in AI infrastructure. They want to be the go-to people. Their revenue guidance for Q1 is 53.5 billion to 56.5 billion, which actually outpaces, it is lower than their current revenue growth of Q4. That's not great to see. Reporting less in anticipated revenue growth. However, they're increasing their capex spending. There's other things going on. It's just going to be interesting to see. Integration of large language models in all their systems. That should be a pretty big thing, opening up and expanding even further. They're going to have higher expenses, but expects higher operating income. Their expenses are going up, but they're anticipating more income. That's essentially what that means. It happens. You don't always get to lower your expenses. AI hopefully is going to help with that, but they're spending so much money and they're doing so much in AI infrastructure that their expenses are going to be to all-time highs. The shift is going to go from metaverse to AI, and they're anticipating similar losses with a following decline for 2026. So essentially, instead of taking their losses on metaverse, they're going to take their losses and spend that money in AI, and then hopefully those losses are going to start to decline. They also have multiple regulation trials planned for 2026 in regard to youth safety and ad personalization. That makes it a little more fearful when you don't know exactly how those trials are going to come out. However, I am a buy on Meta viewing the numbers. Their capex spending is going to be crazy, but you can see when they reported earnings, they kind of skyrocketed up here not long after, 7:30ish, and then they've kind of been working their way back down. I'm still a buy in between this range. 620 to 602.96. If they come back down in that range, I'm going to continue stocking up on my Meta shares. I think it's going to be fantastic if they come back above that 700. I talked about in a previous video that you set some stop losses. I had my stop loss set at 708, and they came back down through, and I actually sold my shares at that 708. So I pulled some profit. Yeah, I owe taxes on the profit, but I'm looking to buy back in if they can come back down to that range that I would like to continue buying Meta for. NVIDIA. All right. So NVIDIA is a little bit more special. And I'm going to throw one other name in there because I believe that they're NVIDIA's actual direct competition outside of Google having their own chips and things along those lines is going to be AMD. Advanced Money Destroyer, as some of you might know them, but they are NVIDIA's direct competition, in my opinion. And that is going to show, it's going to show here when we actually start talking about them. And the reason why I say that is it's going to be when NVIDIA goes up, it's good for AMD. When AMD goes up, it's bad for NVIDIA. And with that being said, I think that they are with the $10 going in the circle, right? I think they're the benefit. They're benefit the most out of that cycle. Because once you buy the chips, once you put in the contract to purchase chips, you're locked in. They don't have to continue handing the money off to the other companies. They have what they need. They're selling the chips to these other companies. We'll get into it and take a look at the numbers. I have never owned NVIDIA, and who knows, maybe we're going to start looking at it. I do actively own AMD, though. Their income in Q3 was $31.91 billion, operating with $36.01 billion. EPS Q3 was $1.30 per share. They are reporting earnings I believe in February. Yep, February 25th. So we don't have if they're going to beat or not yet, but on February 25th, we'll have that info, which is great. Their PE is 45.24, which is actually a little high, but they are a high growth company. Revenue growth for October 2025's report was 57 billion, which was a 62% increase. People talk about NVIDIA, and they are just crazy when it comes to the growth. Their moat is durable competitive advantage, or 80% plus of GPU market. Only AMD is competitive. That's also my opinion that AMD is competitive. I like AMD. I think they got some great things coming for them. NVIDIA is also not going anywhere. It's not AMD is going to wipe them off the map. Their cash flow for Q3 was 22.11 billion, or 60.85 billion, which would have been for the year, which is up 125%. They have 60.6 billion cash on hand, which is fantastic. And their debt is 10.48 billion and decreasing. They are a cash flow king when it comes to this. Most of their money goes straight into cash flow. It's fantastic to see. I love it. CapEx is 5.84 billion, and they are anticipating 8.817 billion. That's fantastic. They're one of the only Mag 7s that don't have insane CapEx spending anticipation. They do have a $500 billion plus backlog. They have $65 billion in revenue guided for the next quarter. China is going to be a big factor too. That's a huge amount of orders and money that they can get by selling chips to China. There's constantly going back and forth in the news on that. It'll be interesting to see how it all pans out. I don't know how it'll go. I believe they're going to be able to sell specific chips to China just like they have in the past. Maybe not their newest and greatest, but we'll see. They have Vera Rubin coming out in the second half of 2026, which is going to be their newest chip. I'm excited about that too. And then if their growth trajectory continues, then revenue is on track to be $1 trillion by 2030. You're talking 4 years away to get to $1 trillion in revenue for this company. That is fantastic to see. We'll see if they stay on track, though. They are kind of hovering in an area that I would actually like. I think I'm going to start to purchase some NVIDIA. I just want to diversify in between the two. If AMD has some setbacks, maybe NVIDIA can kind of support my portfolio when it comes to that, and vice versa. It's not always one winner in a certain market. Sometimes there's multiple winners. Sometimes it's not bad to be diversified amongst different parts of the same sector, just to make sure that you're capturing all the good as well. Trying to avoid some of the bad. Back here, at this 170-ish mark would have been a fantastic time to be picking up Nvidia. I'm kicking myself for missing it. We just had two opportunities almost back to back to be able to pick up some Nvidia. I'm hoping they come back down to the 170 range. That would be fantastic to see. I will definitely be a buy on Nvidia. I'm gonna start opening my shares and my buying process for Nvidia in this coming up week. It'll be interesting to see how it all pans out. I think they're going to be a very strong company for multiple years in the future. They still have plenty of growth. There's a lot of growth already built into the price. But at these prices, I just think it's a buy. I just can't get over it. I think I'm going to start buying Nvidia. Does not mean you need to. It's just I think they're going to be the winner out of all this capex spending. I think it's going to be going towards them. We'll see if that pans out, right? And last but not least, Tesla. Tesla. Income down 61% to $840 million. Their EPS was 50 cents a share, beating by 45%, or 45 cents. Or beating by 5 cents at 45 cents. Their PE is 390 with 5-year average at 185. Way high on their PE ratio compared to these other companies anyway. Revenue growth in Q4 was down 3% year over year to $24.9 billion. Their moat is narrow to wide economic moat, meaning they have direct competition when it comes to their automobile sales. However, they're wanting to get more into robotics, which we're going to talk about in a second. Their cash flow annual of $6.22 billion and operating of $14.75 billion, with $41.6 billion cash on hand. They have low debt at $14.7 billion. That's the only reason why I think they're staying any kind of afloat. Their capex spending was $8.5 billion in 2025 and anticipated to be $20 billion in 2026. All right, so what's going on with Tesla? They have real-world AI. That's what they're anticipating. They're wanting to build AI into everything. They have robots coming in 2027 with the Optimus program, and 2026 is going to focus on compatibility. Now, that means that's where most of their spending is going to go. So, the robotics aspect of things. Everybody's supposed to have their own robot, right? They also have Cybercab, which is going to be direct competition with Waymo. And then they have electric semi lines, which are underway. They'll be kind of interesting. I'm going to do a little more research on semis just to see where they're at and see what the range capabilities are and the recharge times. That would be kind of interesting to see if it actually has any kind of take. However, it may, because, you got to follow those books and keep a certain amount of time off the road, right? So that'll be kind of interesting. I think it might have a little bit of a play there. Their competition from other automated rideshare services has increased significantly. They do have a $2 billion investment in xAI, but with the xAI and SpaceX kind of merging into one, that actually kind of dwindles their investment a little bit. And then there's potential for Musk Corp, meaning Tesla also gets merged into them when xAI opens up on IPO. It's supposed to be one of the biggest IPOs, but that's actually where that $2 billion investment is going to actually dwindle a little bit when xAI opens the IPO and everybody starts investing money into there. They're just going to own a significantly less stake in it, but if they merge anyway, then it really don't matter. I think it would be interesting to see. That would keep Musk focused more in terms of having one major company to worry about instead of multiple. I like Musk. I think he's a very smart, intelligent dude. Tesla is not a buy for me. If I own Tesla, I would actually be a sell right now. I don't think Tesla. I think the market's too unstable right now to actually be able to say that yes, they're going to skyrocket. Now, will they possibly skyrocket? I don't know for sure. There's always going to be a chance that they could take off, and I could be wrong. I'm very open to being wrong. I'll admit it when I am. I just think they're too much of a risk. They're on a downward trend. If they ended up getting back down here in that 300 range that we were a few months ago, I might change my tune a little bit, lowering that PE. But them having negative growth, I just don't see them actually being a buy for me in the near future. All right, so my final thoughts. I already went through my buys, sells, and holds. You got SaaS versus the AI. These companies are full blown towards the AI. They're anticipating taking out or moving forward with the AI and using less of the SaaS. Everybody, it's the SaaS apocalypse right now, all that kind of stuff going on. I actually think that those are more of a buy right now than some of these shares or these stocks. However, with these coming down with the capex spending, it's hard to not pick up and be able to hold both sides of it. That way, no matter what, you're in the winning side, right? The Mag 7 versus the entire market. The S&P 500 and stuff is not actually going down, dwindling, but individual shares are. And Mag 7, some of these are a part of that, especially with the risk of the capex spending. Trump accounts, though, those are supposed to be coming out, and they're supposed to be invested in the S&P 500 index, which is going to be primarily these companies, which is going to be fantastic to see. I actually think that that's going to keep them at a higher price. It's money that can't be touched, right? And then their ETF holdings. If you are invested into ETFs, please make sure you actually look and see what they're invested in and make sure you're diversified properly. That's going to be huge for you in your portfolio to make sure that you're not too much into one of the Mag 7s that, and when they drop 40%, you just get wiped out. Make sure you do your own research. Make sure you know what you're investing in by doing said research. And we'll see if this pans out. If you found any of this info entertaining, helpful, informative, please smash the like button, share with a friend. It helps me out tremendously, and I'll see you in the next one.